Hi, I'm Linda Eedes, and I'm joined today by Rashaad, Tayob, and Farzana Bayat, who are both fixed income portfolio managers here at Ford. And Rashaad is also one of our macroeconomic strategists as well. But we're going to be talking about the banking crisis, or maybe it's a loaded word to say it was a banking crisis. We can debate that we saw recently in the States. But the interesting thing is, in that process, there was some bond debt that was actually written down, and shareholders were actually protected over and above the bonds. So, Rashaad, first of all, can you just give us a backdrop as to why this happened?
Yes, I think banking crisis is the correct term, and it's actually ongoing. So, banks in the US are continuing to bleed deposits because a lot of them have effectively wiped out their capital. Over the last year, you've seen interest rates go up dramatically. Inflation and interest rates have gone up dramatically. And that means that the majority of the balance sheet, which was invested at relatively low yields into bonds and loans, is now well underwater. It was invested at anywhere from 2 to 3%. And they're now being forced to attract new deposits at anywhere from 4 to 5%. And that just doesn't add up. So what we saw with Silicon Valley Bank and Signature Bank was effectively a bank run. Silicon Valley Bank lost $60 billion worth of deposits on a Thursday. On Friday, they were lined up to lose $100 billion worth of deposits in a single day. But the authorities came in, the central bank, the treasury, and effectively shut the bank down and resolved it over a weekend. They protected depositors as a first preference, but subordinated debt holders were effectively wiped out.
And Farzana, what is that? I mean, what is the sort of additional tier one debt? I mean, a lot of people have never heard of that before. I mean, what is that level of debt? And as we've just discussed, I mean, it's quite unusual for bondholders to be thrown under the bus before shareholders on the equity side. So what is that level of debt, and where does it sit in the capital structure?
Okay, so Basel is basically the regulatory standard that governs global banks. And when we shifted from before the global financial crisis, we ran Basel II, and under Basel II, the capital structure was where your senior bondholders were at the top, followed by subordinated, followed by equity holders. And when we shifted to Basel III, so I need to touch on why we shifted to Basel III. So post the global financial crisis, they wanted to issue loss-absorbing assets so that the central bank wouldn't have to step in and bail out the banks in a stress scenario. So the whole rationale behind issuing these loss-absorbing assets was so that they would serve this purpose. The whole, the wording in Basel is very explicit that these are write-down instruments, that the regulator has the power to actually write them down. So when we shifted from pre-global financial crisis to post-global financial crisis, we moved from Basel II to Basel III. And as I mentioned, under Basel II, it was senior, subordinated, and equity. And under Basel III, there was an inversion in the capital structure, where now your debt holders could actually be subordinated to equity holders. And, that was a fundamental shift. And at the time when these assets came to market, your fixed income investors were very nervous because, it fundamentally increased the risk in these assets as you're no longer holding a pure fixed income instrument anymore. And there was a lot to think about in terms of how to price these assets so that you adequately get compensated for that significant risk that you're now taking on.
And is that being done in the market at the moment with regards to this debt and other banks?
So at the moment, when these notes were first issued, as I mentioned, fixed income investors were very nervous to touch these. So in 2016, they were first issued into the market. And at that time, people were very cautious. They wanted to get equity-like returns or risk premium because they felt they were taking equity-like risk. So the credit spread or the risk premium that you were getting on these assets back then was at 7%, so 7% above short rates. And that is compressed all the way down to below 3.5%. So that credit spread has actually halved, more than halved. And, we really think that, and the reason that's happened is people have become quite comfortable with these assets. They haven't really seen a credit crisis. In South Africa, we also have a supply demand imbalance. So there's not a, there's a lot of chase for yield. There isn't enough credits coming to market. So, that's sort of driven down spreads, generally in South Africa. And at these sort of levels, we really think they're very stretched. We don't think there's a lot of value. It's hard for us to see that spread compressing any further. If anything, we think that there's a risk that the spread will widen. And if that spread does widen, the capital impact is quite significant on these assets.
And so we do hold similar sort of debt instruments in South Africa. I mean, in other words, you are able to actually buy AT1 debt in South Africa. Is that correct to say for the banks?
Yeah, so in fact, in South Africa, the sub-debt market is quite big. It's about 157 billion across the big four banks and Investec. So that's a sizable amount of debt out there. And, if a bank does have to get into trouble, it would be very tempting for, the management of the bank, the shareholders, the regulator to all just decide, let's just recapitalize the bank with this write-off debt. And if you take ABSA, for example, their market cap is 160 billion. Their sub-debt is about 30 billion. That's not an insignificant amount that they can use to actually recapitalize the bank. And also, when you look at this, these assets are held across many funds, including cash and income funds. And when you look at this in a portfolio, you would just see first-rand exposure, standard bank exposure. So you would think it's very safe paper. You wouldn't know the seniority of it. And so optically, it can look good in a portfolio. But, the seniority is very important because your outcome in a stress scenario is very different. So in the recent banking crisis, your depositors were fine, but your sub-debt holders were written off. So you had exposure to the same bank, but your risk was vastly different.
And I think we saw that specific scenario recently with Credit Suisse, whereby that's a bank with a very long history, a big name in the market, the second largest Swiss bank, and they had 17 billion euros of AT1 debt outstanding, and that was bought all over the world into income funds, family offices, wealth management type products, and that was written from 100 down to zero over a weekend. And I think that shocked a lot of people in that a fixed income instrument can go from 100 to zero. It's not necessarily normal, but as Farzana mentioned, under Basel III, that's the rules.
But now, it's sort of going back to our kind of using of the word banking crisis. Obviously, the last time we saw a banking crisis was in 2008. Obviously, there we had the whole shadow banking system, a lot of leverage in the system. And there's been quite a lot of debate about whether this has actually been caused by the Fed, who were behind the curve and then had to rapidly raise rates very aggressively over the last year, versus really just like poor management of kind of matching liabilities on the bank side. So, I mean, is this really kind of a systemic issue potentially, or is it actually just banks not thinking about the fact that rates would need to rise quite rapidly to counter inflation?
I think it's a combination. We've had banking crises for hundreds of years, and we will continue to have them going forward because banks are inherently fragile. If you look at the capital, the core equity of a bank, it's between 5 to 10%. That means if asset values fall 5 to 10%, a bank essentially wipes out its capital and it's insolvent. That's not true for a normal company. It doesn't go from 100 to zero that quickly. So if a bank makes mistakes in terms of its lending, it lends too much, like in the financial crisis, too much lending to mortgages. You've had situations where too much lending to hedge funds, commercial real estate, or maybe a sector which is volatile, like commodities or mining. If commodities fall, suddenly banks have lent too much there, they can wipe out their capital because that buffer is so small. So that's the one inherent fragility in the bank. They are very leveraged entities. The other issue is the nature of how a bank operates. It borrows short and lends long. So a lot of the money is taken in by depositors who can pull their money out at any point in time, and then they effectively invest into mortgages, which are 20 years in South Africa. They lend to corporates for 5 to 10 years. So they can't get that money back overnight. So a lot of it is about the confidence, and they need to maintain confidence in the bank so that they don't suffer a deposit run, because once that happens, it's effectively game over.
And aren't we already seeing that? I mean, we're starting to see deposits being pulled out quite rapidly out of the banking system and sort of going into high yielding assets. Of course, we saw Apple coming out with a competing product. So I guess what you're saying, Rashaad, is this a fair way of reflecting your view, is that it doesn't really matter what causes the fragility in the system. It's the fact that you have something that could spill over and that one needs to be cognizant of with regards to the risk in the system.
Yeah, when you have leveraged entities, there is a fragility, and the deposit outflows, the US banking crisis is continuing. First Republic Bank released its results recently, and they showed that they've suffered $100 billion worth of deposits flight in just one quarter. So they've lost half their deposit base in a very short space of time. And as competitors come through, in fact, a lot of their deposits were effectively lazy deposits. They weren't even paying interest. So that's a perfect business model when it works. You're basically borrowing money for nothing and you're lending out at 2 to 3%. But what happens when rates go to 5%? Suddenly you get competitors like Apple come through, offer 4.25%. They take that money, they immediately invest it at 5%. They make a nice margin with very little risk. So people without legacy issues can come in now and capture those deposits and effectively put banks who are already being squeezed under even more pressure.
So to just touch on that, you would wonder, why don't they have a larger buffer for liquidity flow? So they do have, under Basel, they do have something called a liquidity coverage ratio, which the banks have to comply with. But that number is so small relative to the size of the deposit base that, and they sort of say, it's 30 days worth of, average deposit flows that they need to cater for. But as you know, when there's a loss of confidence in the bank, it's not a portion of your depositors that leave, it's the bulk of them, and they leave quite quickly. So, the regulations also need to be reassessed in terms of catering for this.
But doesn't the South African banking system have a completely different kind of backdrop? I mean, we've got an upward sloping yield curve, which means that it's easier for them to pay a lot less than what they lend money out further along the curve. So why would you still be concerned about this AT1 debt locally if the banks are in a much better situation and much better capitalized and have kind of better risk management procedures overall?
So the specific banking crisis that they're having in the US is unlikely to happen here because we run a different system. We run primarily a floating rate system. So if you think about your home loan, that's on a floating rate linked to prime. And when banks give out loans to corporates, it's generally on a floating rate. So there's a natural hedge. They borrow at floating and they lend at floating. And as rates move up and down, it doesn't necessarily affect their solvency, unlike in the US. So that specific risk is not relevant here. But what is relevant is the risk of higher credit losses because of the poor state of the economy. With the electricity crisis, our growth is likely to be about 0.5% this year, maybe 1% next year. And in that type of environment, a stagnant economy, corporates are going to continue to come under pressure. And if you see credit losses increase, those loss ratios on the bank's balance sheets will likely increase. And that's what's likely to affect our banks in SA. And hence, with the spreads, Farzana mentioned how narrow the spreads are on subordinated debt, you're not getting that much value. So for example, Standard Bank issued a Tier 2 bond recently at about JIBAR plus 185 basis points. You compare that to senior debt, it's only 40 basis points extra. So 0.4% you're getting for taking on write-down risk. And as Farzana mentioned, under Basel III, you are taking the risk that you go from 100 to 0, which is, I think investors need to ascertain what type of instruments they are holding. You can't just say, actually, I've got this bank exposure. It's where do you sit in the capital structure? That is going to be more important going forward.
What's also interesting is South African investors didn't seem to be too sensitive to this banking crisis. And in fact, in that 2 weeks where everything was going on with SVB and Credit Suisse, 2 banks in South Africa were actually able to issue AT1 and Tier 2 paper at very compressed levels. And we saw secondary trade as well in the market of fairly sizable, like 50 to 100 million, where spreads compress between 40 and 60 basis points. So, it just shows that, South Africa is in a different, the search for yield seems to be taking precedent over, looking at credit quality.
There's a lot of complacency in the market with credit spreads very narrow. But in our view, they are compressed, and we've been very conservative because we do think credit in general and subordinated in particular has downside risk from this point.
So what I'm hearing from you guys is that, again, it's about sort of being paid for the risk that you're taking, and that certainly the local banking sector is much better capitalized. There's a lot of positives from a fundamental perspective, which is why we're quite happy to hold senior bank paper, but that you just wouldn't dip down into that lower quality spectrum because you're just not being paid for that additional risk that you're taking.
There's another risk that we're concerned about. In addition to pricing, we're also concerned about call risk. And what we mean by that is we're concerned that the banks may not may not redeem it on the call date. So these notes are issued as perpetual, but with a 5-year call date, which means that they are expected to mature in 5 years, and they're also priced as 5-year assets. And, the banks tried to sell this on the premise that they would always call it in 5 years. So investors bought this believing these would be 5-year assets. But the regulators come in and, been very strong in saying that the banks should not create this expectation that they would always call it. And if it's more expensive for them to call it and issue at a higher spread. So for example, at the moment spreads are 3.4%. If now the market demands 7%, the regulator will tell the bank you can't do that. And in that situation, what then happens to bond investors is you now have a short asset becoming a perpetual. And when you move from a short asset to a long asset, your yield has to adjust. You're now sitting with a much longer duration asset, and the capital impact can be in the region of about 30%. And last year we saw a Korean insurer not call their sub-debt, and there the price actually fell 30% in a day. And, for us, we're going to be watching globally what happens. So globally, if we start to see a trend of banks not calling their AT1, then, the South African regulator does monitor global events, and they're likely to follow suit. And later on this year, in October and November, we've actually got 3 local bank call dates coming up, and we'll just be monitoring that space closely.
So it also begs the question, is there a price at which it would make sense to actually hold these assets?
Yeah, I think if we go back to where they were originally issued at around the 7% level, I think that makes it a lot more compelling. The nature of an asset, a fixed income asset that can go from 0 to 1 when a bank's capital is eroded is quite different to normal bonds. Bonds that we know for hundreds or thousands or even thousands of years, debt has been in issue. So it is a very different type of instrument, and you almost have to price it as a out-the-money binary option in a technical sense. And if you do a bit of analysis and come up with a number, you are looking at spreads of 7 to 8% as being more reasonable in that context, given the write-down language, rather than the 2 to 4% that is currently prevailing in the market.
And in addition, you would have to risk manage your position size as well,
Okay, thanks. So we're being very conservative. We're still obviously in instruments which are generating good yields, but again, very cognizant of the price we're paying to actually generate those yields. So not wanting to take additional risk.
I think it's just highlighted the importance of where you are in the capital structure in all these disasters, from Silicon Valley Bank to Credit Suisse to Signature Bank. The emphasis on the regulator has been to protect depositors. So as long as you sit in that systemically important part of the structure, you're likely to be saved. In South Africa, we've got the big 4 banks who control more than 80% of the deposits in this country. The economy, the regulator, the government can't afford to let any of them go. So by sitting in that senior position in the capital structure, you are extremely safe.
Okay, great. Thanks, Farzana and Rashaad, for the conversation, and thanks to everyone who's joined us today.